Ayodeji Balogun. I run the commodities exchange. Also one of the capital markets in instruments, but focus on agricultural assets. And the first part where I want us to take things from is the issue about impact investment. And the question is, what is a what is an impact investment, and how do we really measure it?
Good morning, distinguished ladies and gentlemen, and I must thank the organizers for asking me to join in the discussion. And I thank you very much for the question. From our perspective, we look at investment firms, and we see that there is increasingly an emergent trend where there is more filtering. So, applying exclusion to investment opportunities that would not have ESG considerations, that would not have climate impact consideration. And as a result of that, what we're seeing is that there are a lot more formal investment vehicles that are applied to projects that reduce coal, for example, coal usage, that support SDGs, the Sustainable Development Goals, and actually a lot more funds going in there, in the recent past.
And looking at this, how is this affecting pricing? Is there an impact on pricing? Is there an impact on liquidity and ability to raise more money?
Well, we see that actually there's already more money being raised. If you look at the statistics, I think we've gone from about $18 trillion globally to $23 trillion, which is about a fourth of all investable funds. So clearly, there's more money going into those types of funds, and we know that corporates that run with sustainability in mind tend to outperform normal corporates, and so they're properly priced and rewarded for that.
Now, from an investor, particularly a retail or institutional investor, when you're investing in an IPO, you're actually putting money in the company. And the question is around the secondary markets. When you trade on the secondary markets, the money is not necessarily going into the company as a vehicle. You're buying their stock. Will we still count this as impact investments? From me, if I'm an institutional or a retail investor investing in the secondary markets?
So, exchanges have done a number of things to, facilitate the investment of funds in those types of companies. For example, we have our corporate governance index, for example, right? You have products that have been created, like the green bonds. You have corporates that are reducing their carbon footprint, that are investing in projects that would support the SDGs. And so even when you're participating in secondary market and you're not putting money directly into those projects, you're helping to keep liquidity so that investors that need to exit can do that in a way that is seamless and does not affect the total value of the product.
So it helps them raise additional capital.
It allows you to raise additional capital. It gives you a higher rating, if you will. So if you needed to do that, for example, because it's not only equity, to maximize your enterprise value, you need a combination, a good balance of debt and equity. And so what we find is that corporates that are already listed tend to get better valuation, just better credit ratings, just because of the transparency, the corporate governance, and the rest of it.
So in your arena as the head of NSE, I mean, two particular innovations around issues around sustainability that I have particularly followed is one is the ASEN board for the board for smaller companies. The second is the corporate governance, index. And this is how do you rank companies. And the later particularly I found very interesting how it's moved as something that was introduced to now that if you want to be on the premium board, you have to meet a certain score. And I'll just like to say that evolution and how you've seen that shape behaviors of companies.
It's funny, when we introduced our corporate governance rating system, which is just a system that allows you to get an environmental assessment of the company. So their stakeholders would, the company would do a self-assessment. The stakeholders would do an assessment. The directors would take what we call the fiduciary awareness test. And then you have a group of experts that do the multi-stakeholder assessment. And then you put all of it together to come up with a score. And if you have over 70, then you've passed the corporate governance rating system. We thought it was going to be something that companies would frown at, but once we completed the pilot, it was actually interesting to see, old men who failed the exam now working very hard to pass the exam because their credibility was on the line. And we then graduated from there to corporates that see it as a badge of honor, a badge to show that they have the highest standards of corporate governance in their DNA and therefore integrity that comes with it. So what we see is companies aspiring to be on the premium board. Now, having said that, there are actual economic benefits for being on the premium board. All the empirical studies we've seen show that companies that are on such boards outperform significantly by double digits the equivalent companies that are not on those boards. So we do have our premium index, for example, and the premium index today is about 5% up, while the entire market is about 10% down. Just to give you an idea that even in Nigeria, that statistic, the empirical studies hold true.